After the latest US interest rate cut, the US stock market surprisingly crashed. Isn't this supposed to be a good thing? After all, isn't this the best opportunity for bottom fishing? Every time the US announces it's going to inject money into the global economy, there are always people who either don't believe it or don't even know about it. And because of this, you'll notice that some people, despite being less capable than you, end up with more money. Why? They took action when others didn't. This time, Trump has even hinted that when he takes office, the stock market will be his top priority. In other words, if you sell your house and car, convert the proceeds into dollars, and invest heavily in US stocks now, once Trump takes office, your investments could skyrocket. Trump's implied plan is to push the US stock market to new heights, and anyone bold enough to act now could become wealthier than all their peers and relatives. The idea is that US stocks will become a lifelong cash machine. Any money you withdraw from it will eventually be replenished as stock prices keep rising. But is this really the case? Let's look at history. When Trump took office previously, the stock market rose 49% over 3 years. If you had blindly invested $1 million in US stocks during that time and held on, you would have made $1.5 million, not counting currency appreciation. However, in 2020, the black swan event of the pandemic hit, and the stock market erased those gains in just a month. Everything was reset, proving that no market rises indefinitely. All bubbles eventually burst, or do they? Following the 2020 crash, when Trump promised an unprecedented stock market recovery, the Federal Reserve expanded its balance sheet and printed money. This massive liquidity injection pushed the market back up by 68% in less than 6 months. Many investors came to believe that even if the market crashes, it will always rebound because the US can print its way out of trouble. This belief fuels the idea that buying during a dip is the way to go. However, seasoned investors know that history often shows a major crash precedes a major rally. This pattern helps consolidate wealth among the elite. The system becomes more rigid, making it harder for new wealth to emerge. The only chance for those outside the elite to break through is during a market collapse when resources are redistributed. During these moments of crisis, those who plan carefully can seize opportunities. Currently, many blame the Federal Reserve Chair Powell for talking the market down. While the interest rate cut was small, Powell's comments about slowing future rate cuts spooked the market. Initially, the market expected 4 to 5 rate cuts next year, but Powell's remarks reduced those expectations to only 2. This shift in expectations essentially turns the reduced rate cuts into implied rate hikes. The market reacted negatively, with stocks selling off as a result. But is this all part of the plan? The crash appears to lay the groundwork for Trump's potential return. By creating a steep market decline now, it leaves room for a recovery once Trump takes office, allowing him to appear as a savior of the economy. This also shifts public frustration about the market's decline onto Biden, letting Trump start with a clean slate. Behind the scenes, US capitalists and institutional investors are adjusting their strategies. The focus is on protecting US bonds, treasuries, and the dollar, rather than stocks. Treasuries are critical for the US government to function since they rely on borrowing to fund operations. If treasuries fail, it would signal a complete loss of confidence in the US government and the dollar, which would be catastrophic. In contrast, a stock market crash primarily hurts retail investors and foreign investors, not the core institutions controlling capital. Recently, demand for treasuries has surged, with November seeing record high subscription rates. However, this demand isn't entirely organic. Financial institutions, acting as underwriters, are forced to buy treasuries when global demand falls short. To free up funds, these institutions have been quietly selling stocks, a trend even seen with major investors like Warren Buffett. Despite this selling pressure, the market has remained resilient, largely propped up by foreign investors lured by strong US economic data. However, this dynamic shows that much of the market's recent strength is built on shaky foundations. Historically, during crises like 2008, US elites used government bailouts and other mechanisms to protect their wealth while ordinary investors bore the brunt of the losses. The same playbook could be in motion now. US companies that previously borrowed heavily to fund stock buybacks are now facing higher refinancing costs due to rising interest rates. As these debts come due, companies may be forced to sell assets or stocks to repay what they owe, potentially triggering further market declines. The Federal Reserve faces a dilemma: keeping rates high to curb inflation and support the dollar, or cutting rates to stimulate the economy and ease debt burdens. Both options come with significant risks. High rates strain government finances, with interest payments now rivaling or exceeding defense spending. On the other hand, cutting rates risks reigniting inflation and making treasuries less attractive to investors. Either path leads to difficult trade-offs. The likely outcome is another round of money printing, quantitative easing, to stabilize both the stock and bond markets. Historical precedent suggests that after an initial crash, the Fed and government will step in with aggressive measures to drive a recovery, allowing elites to buy undervalued assets at a discount before inflating the next bubble. This scenario aligns with past crises in 2008 and 2020. In conclusion, while the recent market dip may not yet signal the start of a larger crash, the warning signs are clear. Investors should remain cautious, avoid chasing rallies blindly, and focus on short-term tactical opportunities. The current environment rewards flexibility, quick decision-making, and a willingness to adapt to changing conditions.